Welcome back to another exciting episode on the show, Control or Be Controlled, a podcast designed to help you start thinking differently and take control of your life. And I remain your host, Darlington. Today's guest is Chris Ighodaro. Chris is a financial coach with more than 20 years of experience helping individuals and families build financial confidence and long-term security. Drawing on his background as an investment specialist, Chris believes that financial success isn't just about growing wealth, it's about building strong relationships, making informed decisions, and creating a plan that reflects your personal goals and values. Today, we will discuss practical money management, investing, financial confidence, and the habits that help people create lasting financial security. Chris, welcome to the show.
Thank you very much, Darlington, and thank you for the introduction. It was perfect.
All right, Chris, thank you so much. And I am happy you enjoyed that introduction. Okay, so I have some questions here for you, and I would like us to get into them.
Wonderful. Take it away.
Okay, so you are a financial coach, right?
That's right, yes.
Okay, so can you tell us what inspired you to become a financial coach after spending 2 decades in the investment industry?
I have been involved with a lot of training with the wealth managers and financial advisors in various companies that I worked in. So I worked for one of the largest wealth managers in the United Kingdom, and I was part of the induction program. And that program was helping young advisors who were new to the industry learn specifically about the investment solutions that were available to help them go out and speak with confidence and clarity to their clients. So I was part of the program. I was part of that academy, which went out to help those advisors. I mean, I spoke with over 300 advisors in this capacity over 2 years, enabling them to really help and to allow their best selves to come out in conversations. So some of the things that I would be teaching them was in the area of portfolio theory, construction, asset allocation, and the differences of risk and return and how that impacts investment decisions. So I really was interested in how to break down complex information and distill that to the cohort of people that I was speaking with. I also was involved for many years with meetings with the clients of financial advisors all over the United Kingdom. I would be brought in to sometimes explain what's going on in the world. I would be talking to them about what's driving things like UK interest rates or what is the main drivers of the US market. I'd be talking to them about the simple concepts of diversification and talking about performance and how sometimes that might change. So in that capacity, I think I was teaching as well. I was sitting down with people who wanted to know more about investing, and I was helping those clients to really understand their portfolios. So I just got the idea, essentially, because I had already been sitting down with people for a long time, either professional advisors or with clients, I felt that it would probably be a good idea to take some of the things that I saw as best practice and coach people on a bespoke and a more personalized, tailored approach I thought would work in this coaching service that I have now launched on my website, which is manresaschool.co.uk.
All right. Thank you so much, Chris, for that wonderful answer. So, can you share with us the biggest financial mistakes that you see individuals and families make?
There's quite a few big mistakes that people make. I think the one that comes up most often, rather than the biggest, and I think that would be most useful to your audience, is panicking when they read a little bit of news and they conflate the economy and what's happening in the economy with their investments. And I think they then go on to make mistakes, such as they look at their investments and they look at the solution that has been provided to them, and they sell based on short-term news and short-term noise. And that is a mistake, because short-term fluctuations and volatility is a hallmark. It is part of the cost of investing. People think of cost of investing purely in terms of perhaps fees, the amount that you might have to pay. It really helps to educate people that the cost to investing also is the volatility that they might see, the emotional challenges that are part and parcel of investing. There are going to be periods where you're going to see your portfolio rise, and that's going to give you a great feeling. But there's also going to be periods where you're going to see your portfolio drop. And again, that's where you might get despondent. You might have some doubts and anxieties. It's okay to have feelings. We all have feelings, but you need to separate your emotions from making rational decisions. And I think the psychology of saving and investing is underappreciated. And I think more work needs to be done here so that people can avoid the short-term fluctuations that happen in markets and make a more informed decision by sitting down with a financial advisor or financial coach where they can talk to you about how this is a frequent thing and that this is a cost. This is part of the cost of investing from an emotional standpoint. So I hope that kind of gives a flavor for really the area that is most common when I'm talking with investors and savers as to where to avoid, where to prevent mistakes being made.
Right, Chris, thank you so much. So, tell us why building financial confidence is just as important as building wealth.
I think financial confidence is important because it helps you really make accurate decisions, or it improves your ability to take the necessary steps. It allows you to look at what you're reading, and when you've read that, you get a better idea. But that can only happen really through time and through making mistakes. Confidence happens by really participating and by observing, by reading, and understanding that sometimes there are going to be mistakes that you will make, but it's about the long-term journey. Those mistakes in the short term are preparing you for the big opportunities that might await in the future. And if you can separate that out, that the mistakes can lead to huge opportunities, and I've seen that time and time again, that I feel really is part of the secret ingredient. You might not know it at the time, but I think over time, going through the necessary steps and understanding and reading and being curious about investing and about finances will lead you to having a better confidence. I have seen this in myself. I've seen my confidence grow, and that's come through experience. It has come through seeing big downturns that there have been. When I talk about these downturns, and I have been in the financial markets, and I have worked in this industry for a long time, I've seen the bounce backs that have happened. So I'll give a few examples. In 1999, there was a big decline going through into 2000 of so-called .com stocks. So these are sort of the earlier tech stocks that were the main companies that formed the internet. So your companies like Cisco and Microsoft and AOL, these are companies that were the companies of tomorrow, of the future, and they declined in a massive way in 1999 because there was a lot of exuberance. Valuations had got way ahead of themselves, and at the time there was a big decline because prices had risen too high. But over time, you've seen actually those companies, especially Microsoft, recover from those declines and really power to new heights. Another example is during 2008, which is termed the global financial crisis, where lots of the banks had to be bailed out. A lot of those banks who were bailed out by their governments have now paid back the money that was used to help them get through that negative period and grown. One of those companies, for instance, that I would highlight that has grown to such a huge level now is JP Morgan, a US bank. JP Morgan was one of those banks which suffered, like all financial institutions, but have grown since 2008, 2009 to be one of the largest sort of companies now, not just in the United States, but in the world. So I think part of that confidence is being part of the story and observing and seeing these stories come through. And you don't actually have to experience them yourself. You just have to have a curiosity and read about previous crises that have happened and how companies have bounced back. So I think that's where I would sort of leave it in terms of answering that question about where I think your audience should get their confidence from. It's by really reading as much as possible and understanding that time will give you the confidence. You're not going to get it straight away.
All right. So, Chris, you think financial confidence is important to recover from financial loss?
I think so. I think that financial confidence and financial loss are things that you can really think about as sometimes things that go hand in hand. I think some of the best investors in the world have talked about the losses that they have made. And the idea really, if you speak to a lot of these investment managers who are responsible for managing billions of pounds worth of money, is the idea is that you make you make less mistakes really over time. The ability to make more informed decisions grows over time. And I think the golden rule for a lot of them as well is essentially making more of the good opportunities and really thinking about risk management to reduce the mistakes that they make. And what I learned from speaking with clients is the concept of multi-asset class investing. What do I mean by that? It's looking at the different building blocks that might make up the investment universe. And they can be put on a spectrum of risk. So on the sort of more cautious end of the risk spectrum, you have things like cash, and you have cash-like products such as foreign exchange. You might have government bonds, which is like an IOU, where you give money to the government, and for that they give you interest for a fixed term, and then they return you your capital that you've lent to them over time. Because governments generally, especially United States, Europe, they don't go bust. It is seen as quite a low risk investment, but at the same time, you're getting a fixed return. So that would be on the lower end of the risk scale. And then on the far end of the risk scale, for instance, you would have stocks or shares. And even further out, an even more riskier end, you might have cryptocurrencies, for instance, where the price really on a day-to-day or a month-to-month basis moves with quite dramatic falls and rises. And that's what we're thinking about when putting together a multi-asset class portfolio, is looking at the different characteristics that exist between the different asset classes, is thinking of it like a dance and how they all dance together over time, and you can blend that together using the different characteristics of each of those building blocks, which I've just described, and you can put a certain exposure that you're wanting from each one of these building blocks to give you something which mitigates against financial loss over time. It's what gives you the optimum blend of risk and return, so that when the market drops by 15%, you might only drop by 5% because you have less exposure to the parts of the market which really have declined. For instance, what we're seeing at the moment with the semiconductor sector and the chip sector and the so-called Magnificent Seven, what you're seeing with those companies are declining. If you have less of an exposure to those types of companies which are bringing down the overall market, and you have more of the bonds on the other side and more of the cash and some of the elements in between of that, such as real estate investment trusts, or you might have some commodities. If you've got a blend of those different assets which are offsetting the more riskier elements in your portfolio, that is what brings you down at a less more detrimental level compared to the market. So it's understanding and researching where you are in terms of your journey, and thinking about your attitude to risk and how much you might want to wait in crypto, how much you might want to wait in crypto versus how much you might want to wait in cash, and making a judgment based on that. Most investors who I've worked with have what's called a balanced risk profile. So it means that they are prepared perhaps to suffer declines of around 20% over a year period. Any more than that, then they start to get anxious. They don't want to wait any longer for that 20% decline to return back to perhaps, or reduce down to maybe a 10% decline. They get nervous about that. So for those types of clients, you would have a split of perhaps 50% in stocks and shares and 50% made up of cash and bonds. And so that sort of mix there offsets the times when markets might be declining. So really what I'm introducing to a lot of your audience now is the concept of asset allocation, which I'm happy to go into more detail, or maybe people might want to contact me at a later time to talk about that and how that might help for them in their own investment journey. Thank you, Darlington.
Right. Thank you so much, Chris. I'm just curious, do you really consider crypto an investment?
Do I consider it?
Yes, as an investment.
This is one of the areas which is the most contentious at the moment for people who invest. Is crypto really an investment, or is it just a trade? And I think for your audience, it might help to really define the difference between a trade and an investment. A trade is something which is directional over a short-term period, and you have a clear strategy for where you want to get in and where you want to get out. You've worked it out, you've done your analysis, and you make you take your action, essentially. That is very different from investing. What we think about in the wealth management industry when we're talking about investing is capital and employing that capital to help a particular company grow. It's more of a long-term approach. It is having the confidence to decide that the investment that you're making in a company is because you've done your research, you believe in what it does, and you believe that you're going to be rewarded not only with strong growth in its price and basically your return over time, but also that that company will become strong in terms of its cash flows and its earnings, that actually it can reward you over the long-term journey on a annual basis by paying you what is called a dividend, which is like just an income, which is a share of the earnings or the profit that company makes on an annual basis. So you're really, really getting into the details now from how investment managers think about the differences between investing and trading. And just to say that, is it possible to do both? It is possible to do both, but know the difference. And knowing the difference is very important, because if you're nursing a very big loss in a trade, it probably makes sense to get out, because that's not really a long-term investment, and it's your thesis as to why you got into that particular investment as a trade is probably gone wrong. Whereas you can pretty much take a loss for an investment as long as the investment journey of the company or the story that the company stated has not changed, you can be pretty much sure and confident that the price is going to come back and actually grow over time. It's a bit like what we talked about with Microsoft. If you believe in the long-term story of Microsoft, its ability to change the world through the computer and the internet, and through cloud computing, and now through AI, then it doesn't really matter about the price fluctuations over a short-term period. The story is in front of you. You can see it all around you. There's something feasible, there's something tangible you can see in terms of what it's trying to do. Thank you, Darlington.
All right, thank you so much, Chris. So I'm just wondering, can you share with us habits that separates people who achieve long-term financial security from those who struggle?
Yes, of course I can. I think the first habit I would highlight is that of curiosity. It is having an interest in this area. And that's the kind of people who decide that they want to seek financial advice or want to seek financial coaching. You have to have an interest in this particular area to master it, to succeed in it. But I think as well, it's about starting early. And I've seen a lot of people who start their investment journey very young. And because they started very young, they see the benefits of compound interest. Compound interest, of course, is like the snowball effect, a little snowball growing into an avalanche, because it's interest that's building on interest and interest upon that interest, and it just continues to grow. In fact, an interesting fact is that most of the money that Warren Buffett has made over time has been in the latter stages of his life versus when he was perhaps in his 40s or 50s. And that's because of that compound interest growing over time. So, you need that really working in your favor as well as a habit, is sort of thinking about this young. Another habit, I think, is really thinking about the differences between the economy and the stock market and separating the two. For instance, if I look at the FTSE 100, which is the 100 leading UK companies, you've got to separate that from really what they do and from the economy that they are part of, the UK economy, because a lot of the companies in that index, such as Rio Tinto, such as HSBC, they derive a lot of their profits, not just in the UK, they derive their profits from activities all over the world. So that means, therefore, that it doesn't really matter what's happening in the UK economy in terms of the overall earnings of these two companies which I've just cited, because it generates and has an exposure and has clients and services that spans the globe. And so I think that's a thing that your audience should really be thinking about as well when they're thinking about success and having a habit of thinking about. And the last habit I'd think about is thinking about a trade and an investment, and that there are two sides to every. But there's a buyer and a seller. There's two sides to every investment that you make. And you need to think about the other person on the other side of that investment, of that trade. So if you're buying, you need to start thinking about why is the person who's come to market selling. And I think by thinking about that, thinking about that psychology, upturns really how you think about investments if you're using a different frame of mind. to really assess the investment that you have. And that can be revealing sometimes. And sometimes that can actually change the sizing of your investments. You might reduce the sizing of your investment if you start to think about, well, why is this person come to market? Why is this person selling now? Why now? And it's the timing of that as well that can really sort of be quite revealing. So those are the three sort of tips I would say in terms of, or four tips I would give to your audience in terms of success in investing.
All right, Chris. Thank you so much. As you can see, I already have someone here already on the show. So, for listeners who would like to connect with you and learn more about what you do, how can they do that?
Well, thank you very much, Darlington. So, anybody who wants a investment review or wants more coaching, let them contact me through my website, which is www.manresaschool.co.uk, and then contact. So they can contact me. We can have a quick free 15-minute chat. They can talk about what they want, what their objectives are, what their aims are, and we can take it from there.
Right. Thank you so much. And thanks to my audience as well. You guys are the reason why we are able to do this. And if this episode is speaking to you, make sure to share it with someone out there who might need to change their financial life. Thank you so much, Chris, and do have a wonderful day ahead.
Thank you very much, Darlington. And to your audience, thank you very much for listening. I hope you found it useful.
All right. Thank you so much. Bye.
Bye.